Right, joining us now is Mayuresh Joshi, fund manager at Angel Broking. Mayuresh, thanks for taking the time out today. And well, what a session we've seen as far as the markets are concerned. It's been total mayhem in terms of this Monday, the trade and the way markets have collapsed. It's been a total meltdown in terms of markets. The last time you saw almost a 6% fall was somewhere in 2009. What did you make of this crash up we've seen on the markets today? And more importantly, is there more weakness on the cards here?
Evening, Priyank. Clearly, I think the global currency rout is what has caused mayhem in global markets. I think India is not shielded from the fact that if there are weakness in other emerging currencies as well, you are going to get affected. So in that sense itself, I think very difficult to make a comparison or a case that are we probably looking at what happened in 2013 in terms of the currency crash. We're better off in terms of our forex reserves in excess of $350 odd billion. RBI is in a position to probably use that when it intends to use that at that point of time. And with the rupee depreciating, I think the export competitiveness of India automatically adjusts itself with other emerging economies as well. So I think the fear on the market is how the yuan devaluation will play out in terms of currency wars going through. And again, I think those fears are coming through in terms of the deflationary impact coming through on world economies and global growth slowing down. Clearly, domestically, I think a lot has been factored in terms of reform processes getting delayed, earnings being weak, monsoons probably not coming through as expected. But again, I think this is more global in nature in my opinion. So yes, I think we are not decoupled in that sense. So if the global markets keep on correcting, we might correct. But again, I think as I'm stating, I think we are in a much better position when it comes to the external factors. Specifically with oil correcting, I think the twin deficits, both the fiscal and the trade deficit, would improve drastically in favor of India. So I think the corrections might come through if the global markets correct. But again, I think it becomes a good opportunity for long-term investors who, in my opinion, can start nibbling into the markets at periodic intervals.
Yeah, but Mayuresh, it's going to be investors to somewhat digest this kind of volatility. So what kind of range do you believe is more or less of a comfortable level to actually go ahead and say, well, we may have somewhat bottomed out? Because, a couple of the arguments that we've been picking up from strategists is that the valuation had become extremely stretched. There were a couple of reports highlighting that as well over the last couple of weeks, but markets may have ignored it to a certain extent. But the fact here is there a certain range to your mind where markets then finally become fairly valued, and then they probably have, you've already more or less discounted all the negatives, you more or less factored in all those concerns, and then it becomes somewhat of a comfortable level for investors to start looking at it again?
So clearly, Priyanka, I think over the last few months, we were working on the range of 8100 to 8600 of the Nifty, and we are extremely optimistic that 8600 will not get broken through. It will face safe resistance it has. But clearly, I think very difficult to find out or probably predict what kind of a bottom the market might make. But if global conditions persist the way they are, and unless I think the central bankers in emerging economies specifically, I think, take some action over the next few weeks, I do not foresee the markets bouncing back. Yet, I think there would be some amount of a trading bounce back happening over the next few days. But clearly, I think the range would come down to lower levels. So I think it's breached our lower end of the range that we were probably foreseeing at our end. But clearly, I think very difficult to predict what kind of corrections might come through from the current level. So I think for long-term investors specifically, I think this becomes a good opportunity, as I said, to put at least 10% of the corpus in terms of fresh incremental investments. From a trader perspective, I think another 10-15% from the current level, at least in terms of downside, is not ruled out. So I think we are working out on the range which might just come lower, and the top end of the range might just get tapered down to that 8,200, 8,300 kind of a mark, unless things change probably on the international scale, as I was mentioning earlier.
And are we seeing a larger breakdown in the momentum? Are we seeing a larger erosion out here? Because I buy your point, what you're saying out here, that you can possibly start nibbling at the market. But the larger fear is because there have been enough concerns that have been doing the round, maybe in the domestic or the global front. You always have the fact that 2008 always plays back in your mind when you see such a fall like this. You probably have the Asian currency crisis as well, if you talk of a little bit of a longer period. And there are various market cracks that we've actually seen in the last couple of years. Is this somewhat turning out to be one of those mega global events, or you believe it's unlikely that we'll move into that kind of bear market zone?
So Priyank, too early to call that. Again, I think the data points are solely coming out of China, and again, I think one really had a feeling in terms of how the real estate bubble went off, the leveraging positions on the stock markets there. So clearly, I think all these emanating effects are coming through what China has probably undergone and what China is doing. So it clearly points out to A, I think risks happening on the deflationary front, as I mentioned earlier. B, the kind of currency wars that can probably come through. Because I think every competitive economy would like to be extremely competitive if China is devaluing their yuan in terms of how their exports will pan out. Having said that, probably what the Fed does is also an important aspect. But clearly, I think looking at the scheme of things, the Fed will probably look at interest rate hike, in my opinion, coming after December of this fiscal. So clearly, I think the markets to a certain extent are trying to discount certain facts, at least globally. But clearly, one really does not understand or is not in a position to probably interpret data in terms of how it will pan out. So as on date, I think I'm not foreseeing or foreseeing anything major happening drastically in terms of how data points will pan out on a macro scale globally. But clearly, I think the way the currencies are correcting and the way the flows are happening towards safe havens like gold or even the US Treasury yields, I think that is one scene that can still continue from a short-term perspective. So the pain can persist for some length of time unless the dust settles over the next few days or weeks. We might still consider that the markets will keep on correcting. You might have trading bounce backs. But again, I think the overhang on these markets will ensure that I think the markets will feel the heat for some length of time. So clearly, I think correction is on the cards. There are a lot of margin calls which have got triggered today. And again, I think the sentiments have got soured. So I think nobody really has the guts probably to come down and buy aggressively in these markets. Everybody is in a wait and watch mode and see how things pan out over the next few days.
All right, just hold that thought. In fact, let's talk about IOC as well. The OFS has been oversubscribed. Vivek's been tracking that one. Vivek, what's the value of the oversubscription and how much is the government hoping to get from it?
The stake sale in Indian Oil Corporation is the fourth stake sale by the government since April 2015. Now, the government, if you recall, on Friday actually went and said that it's going to divest almost 10% of its 68.5% stake in IOC. Now, the government was looking to fetch almost 9,500 crore from this stake sale and fix the floor price at 387 rupees a share. Now, 20% of this offer was fixed for retail investors and they were actually getting a 5% discount to the cutoff price. However, no one could predict that the markets would crash to such an extent today, almost 6%. And now what analysts are telling us is that there was a good possibility that LIC has actually gone ahead and stepped in at the last moment to bail out the government. The issue was actually oversubscribed 1.18 times as of 3:30 p.m., which was the ending time for the OFS. Back to you.
All right, Mayuresh, any thoughts here as far as the OFS is concerned? Because it's not so much to do with the way the quantum or the way the participation is panning out there. It's also the fact that in this market, in this environment, they've also got some of the other larger divestments that are planned as well. What's your thought both as far as this OFS for IOC is concerned and divestment on a larger scale as well?
So clearly, as far as IOC is concerned, Priyank, the obvious benefits for a lot of these OMC companies, including IOC, is quite evident on how the numbers are panning out. Under recovery is going down substantially, debt coming down substantially, which effectively means that the working capital constraints that a lot of these OMC companies were facing a few quarters back is no longer there in their books. Clearly, I think all the positives are there in the stock, but how GRMs will pan out is one important aspect to be seen in terms of how Singapore GRMs have panned out for the last month and a half. It seems unlikely that the kind of GRMs they posted in the last quarter would sustain. Again, I think what kind of capex plans that they have would clearly have a toll in terms of how expenditure takes place in terms of cash flows coming through on their balance sheet. So yes, I think from a trading perspective, these stocks might react, but structurally, I think I'll still wait for declines on the OMC pack. As far as the larger theme of divestment is concerned, for a lot of these government issues and paper to be pushed through, I think the government would wait out. I think they would wait for the markets to stabilize because these conditions are not conducive to probably get through papers at this point of time. So any papers that they're probably concluding or hoping to get through over the next few days or weeks need to probably get back to the drawing boards. Calculations need to be reworked again because I think the global markets clearly are not in a position right now, or all of the retail investors for that matter, to probably digest this paper coming through, specifically at short notice if it comes through. So again, I think the government probably needs to wait and watch until the markets stabilize.
Sure. And, Mayuresh, I dare ask you this, but if one has to start nibbling in, or one has to, probably one needs to probably start looking at a couple of the sectors out here, which do you believe should be the ones that, investors or long-term players should start looking at first when we talk about top themes?
So from theme perspective, Priyank, I think private banking is something that is continue to like. I think the kind of fall that we've seen is unprecedented in my opinion. Clearly, I think they have held up in terms of how credit growth has panned out, that asset quality has held up. And if you just assume the domestic situation the way it is, or even for the next 2 to 3 quarters, we're not seeing huge amount of numbers that will point out to degrowth specifically for these sectors. There's a kind of correction that we've seen in stocks like Yes Bank, Axis Bank. I think some nibbling can definitely be done there. In terms of the other sector, information technology, IT is something that we'll continue to prefer. So stocks like TCS, HCL Tech, Infosys, in our opinion, present brilliant buying opportunities. The rupee itself has corrected close to 5.8% against the euro, 3.5% against the dollar. And clearly, I think those tailwinds will come through or accrue through for IT companies. The valuation bands anywhere between 14 to 18 times for IT companies, and into a simple comparative check between the kind of valuations that IT companies and pharma companies are deriving, which are in the higher 20s, between 24 and 28 times forward earnings. Clearly, IT companies pose a different set of a ball game in terms of how the earnings might pan out. So in terms of constant currency growth as well, both in US and INR terms, our take is that IT companies should do well over the next 2 to 3 quarters. So clearly, I think IT is something that we'll continue to prefer along with private sector banks. So some nibbling can happen in stocks related to both these sectors over the next few days.
All right, Mayuresh, fair enough. We leave it there. Thanks so much for joining in and sharing your thoughts and perspective in terms of what the market outlook looks like going forward from here, and a couple of themes to bet on. On that note, it's a wrap on this edition of Markets Rewind. Thanks for watching. Stay tuned. More news and updates coming up after this break.